people having $1 million in the bank and only getting $200,000 back. There are when there's any of these recent bank failures, the FDIC swoops in. They maybe park the bank. JP Morgan absorbs it or something like that. Or if the bank just goes out of business, they just pay off everybody up to whatever that $250,000 level. So there aren't a lot of stories about people just getting completely wiped out, and so therefore they think, well, it's really not that big of a risk. But man, when it all begins to accumulate, especially at the regional bank level with their exposure to commercial real estate.
In today's market recap, silver price gains are outshining gold's thanks to China's overproduction of solar panels. Silver prices have soared 35% this year, hitting 12-year highs at about $32 an ounce. Silver's rise is driven by industrial demand, especially for solar panels, amid green energy shifts. China's strong silver demand boosts imports, with domestic prices higher than international rates. Record high gold prices are in the spotlight, but it's really the yellow metal's poorer cousin, silver, that's outperforming in the price rally. Spot silver prices have gained 35% this year to date, reaching 12-year highs. They're now about $32 an ounce in comparison, but have gained just 14% so far this year. While gold's bull run has been driven by central banks' desire to diversify their assets and a consumer flight to safety amid macroeconomic uncertainties, particularly in China, silver's dazzling performance this year is underpinned by industrial demand. In particular, silver is a key raw material for solar panels. They're in demand amid the world's transition to sustainable energy, and China has raced to manufacture them. China's demand for silver is so strong that domestic prices of the precious metal are higher than international prices. Now we'll show you the best clips of the latest interview, but first, like and subscribe as people who regularly watch our videos are better informed.
Absolutely. And you can, there's these ideas that are, some people say, are opposed to each other. Somehow they're mutually exclusive, but they're not. The bullion banks can manage and manipulate the price of the precious metals to certain price targets almost on a daily basis. But that doesn't mean price can't go up. I mean, that evidence is right staring you in the face, right? Gold's gone from $400 to $2,400 in the last 20 years. But the bullion banks, there's still a JP Morgan Global Precious Metals desk, right? There's still Citigroup. There's still, UBS, Goldman Sachs, go down the list. So there's money to be made. What they can't have is a 50% year. That'd be catastrophic. I think the best year we've seen, while we've gone from 400 to 2,400 is about 25%, 28% back in 2011. Okay. They can manage 10%, 30%, 50% is a whole other deal. And that gets back to what you mentioned earlier, Dunnigan, about the four heads of different bullion banks, these trading desks, JP Morgan and HSBC, and I can't remember what the other two were, all ran over to Shanghai back from a period of late March into early April. I mean, there's Reuters stories on all four of them. Some of them use the same picture. And that they're just caught in a jam now in silver, in that, we get reported through the CFTC their gross positions, and, you can compute the net positions every week with the commitment of traders reports. So we know from that data as a group how much net short they are, not even including the producers that are allegedly hedging or selling forward, just what are called the banks, the swap dealing banks. They're currently net short about 40,000 contracts. What, 5,000 ounces a contract? That's $200 million. And you're like, well, wait a second. Every dollar that the price goes up, then that's $200 million in losses. So you think, okay, well, they've got an incentive to keep price in check. But the problem, if they keep their price, the New York price in check, and the Shanghai price keeps going like this, well, now that an arbitrage opportunity develops, and all of a sudden the silver that is backing the exchanges, and all their derivatives and the leverage there, all of a sudden they risk losing some of that. So it's like, okay, we can either keep the price low to keep our paper short position from, accumulating a couple $1 billion in losses, or we could risk kind of an existential event and have our vaults get drained. And so that's what I mean, kind of a rock and a hard place. Now, one last thing though on that. To you and me, it sounds simple, right? It's like, hey, look, Shanghai last night was trading $36 an ounce. And in the US, it's 32. So simple arbitrage is you buy in the US and you sell in Shanghai. US price goes up from the buying, the Shanghai price goes down from the selling, and you close that gap. Well, is $4 enough to make that profitable? Is $4 enough to take the risk? And that's something that when I hear people or read people talking about this potential arbitrage, I think gets left out, because to execute that trade and to close that gap, you have to buy in the West and sell in Shanghai. Okay, well, if you're buying in the West for future delivery in Shanghai, you better be darn sure you can actually get your hands on that metal, much less ship it over there and do everything else, and customs and everything else you got to do to get the metal into China itself. Because otherwise, the other end of this thing is short. So do you want to be, if the COMEX or a bank in New York says, we'll get you this in 90 days, do you want to be left hanging out here short in Shanghai? Right? It's like getting sideways with some of the guys, walking down the street in Newark. I'm thinking about, like a Sopranos episode or something here. I don't want to get sideways with Shanghai at all on this deal. So there's a risk to putting on that ARB, just because I don't think anybody could ever feel comfortable in size, a couple thousand contracts worth, 10 million ounces or something in size, enough to make that ARB worthwhile. And so it just continues to widen and keep going this way. Again, it's a very interesting situation we're in, and not one that many of us really anticipated as the year began.
In today's news recap, the booming silver demand may lead to extreme price action, TD strategist says. Silver is the latest mined material to experience an uptick in global demand thanks to its uses in electronics and clean energy technologies, and a commodities expert predicts the price of the metal will continue to climb. I think that silver is probably the most exciting trade in the energy transition theme within the commodities complex today. Daniel Gali, a senior commodity strategist with TD Securities, told Bloomberg in a Tuesday interview, "What we're talking about here is a market that has been in a universally recognized structural deficit, essentially driven by the boom in solar capacity across the world and the growing trend of electronics being embedded in everything that we do, but particularly so in vehicles." The price of silver was hovering just shy of $32 an ounce in Tuesday afternoon trading, the highest price on record aside from brief spikes in the early 2010s and late 1970s. Gali said the recent bullish run is due to a historical lack of investment in silver-specific mines, which has led to supply worries in the industry as demand continues to boom. Silver is primarily mined as a byproduct of lead and zinc mines, of copper mines, and of gold mines, so there are very few companies that mined silver specifically, he said. Gali added that until recently, supply deficit concerns had been tampered by a massive amount of above-ground inventories that could be relied upon to balance gaps in silver markets, but he expects that to change. Now, we'll show you more clips. But first, subscribe and turn on notifications and check our pinned comment for some massive sign-up bonus.
Oh, brother, this is another one of those tomorrow's going to be just like yesterday things, because who's left alive that can Joe Biden maybe that can remember a time when the dollar wasn't the world's reserve currency, right? It's just, we're going back to 1944 or 5. All the World War II veterans are all dying off, and so it's like, well, it's always been this way, so it's always going to be this way. No, it's not what history would suggest. And as you point out, there are a couple of things that have happened last couple of years that are like, the term dying by 1,000 cuts kind of thing. These are pretty substantial cuts. Back in March, right after the Ukraine war started, back in March of 2022, the U.S., as a way of sanctioning and punishing Russia, froze their non-domestic foreign currency reserves and kicked them out of the SWIFT system, which is the international payment system that allow you to do business internationally. Thereby kind of making the impression that you better play ball. You don't want to get side, it doesn't matter what you think, what anybody listening to us thinks about Ukraine and Russia and all that kind of stuff. What matters is what the Russians think in this case. And if they look back and other countries go, let's see here, if we ever get sideways with the U.S., they're just going to kick, and it's inevitable we're going to get sideways with the U.S. because we have our own national interests that we're going to pursue. And at some point, the U.S. is probably going to decide that's counter to the U.S.'s, and therefore they're going to kick us out of SWIFT and seize our foreign currency reserves. So when that happened, that was a real blow to U.S. dollar hegemony, if you will. It doesn't mean it. Obviously, the U.S. dollar is still the most widely used thing in global trade, and by far the largest held item in foreign currency reserves in the world. But it definitely, the events of early 2023 or 2022 it kind of spun the wheel towards getting rid of the dollar, de-dollarization a little bit faster. And so where do we stand now? We've got all this talk about whether the BRICS countries, Brazil, Russia, India, China, South Africa, go down the list, how many BRICS plus, whatever you want to call it, are going to come up with an alternative to the dollar. Not something, it's not because I see this a lot too. It's not like it's binary things. Like one day it's a dollar and one day it's something else. No. It's just it's an alternative. It's competition to the dollar. And if China and Russia and India and go down the list have a unit that they can conduct international trade in, that they have confidence in the value of it, not fluctuating up and down 20% in a month, but it stays relatively stable. They have confidence in that unit. They're going to use it. And if by using it, you decrease demand for dollars, right? And your audience is smart. They probably understand the supply and demand. You got supply, you got demand, and where they meet is price. Well, if you increase supply, which is what we're doing day after day, month after month with more and more debt, while at the same time you are decreasing demand by virtue of these alternative currencies, well, then the value of said good falls. The price falls.
What do you think of today's show? Will the Shanghai COMEX arbitrage destroy all shorts, as Hemke pointed out? Will gold and silver soar, destroying the banking industry? Post in the comments section down below your honest opinion and watch this video right here because it's a perfect fit for you. I see you on the other side.